Hello and welcome to another deep value video. Today taking an in-depth look at Alibaba Group Holding Limited, ticker symbol BABA. We'll dive into financial metrics, assess the company's growth, and ultimately try to find its fair buy price. Alibaba Group Holding Limited, branded as Alibaba, is a Chinese multinational technology company specializing in e-commerce, retail, internet technology. The company provides consumer to consumer, business to consumer, and business to business sales source services via Chinese and global marketplaces, as well as local consumer, digital media and entertainment, logistics, and cloud computing services. It owns and operates a diverse portfolio of companies around the world in numerous business sectors. The stock is priced at $90.5 with a market cap of 209 billion. Let's have some key valuation metrics. The price to earnings ratio stands at 24.2 and the price to cash flow ratio is 8.9. The median P over the past 10 years was 28.2, so they're trading below the historical average. Over the past 5 years, the company's revenue has grown by 81.1%, and its bottom line has decreased by 47.5%. In terms of earnings per share, there has been a decrease of 45.2%, and notably, the number of common shares outstanding is 2.5 billion, a minus 5.8% change over a period. Now, this assess the company's liquidity and solvency. The interest coverage ratio is 15.9, indicating the company's solid ability to handle its debt obligations. The quick ratio, a measure of the company's short-term liquidity, is 1.41, which is very good, suggesting a high ability to handle short-term liquidity shocks. And additionally, the long-term debt equity ratio is 0.17 and the total debt equity ratio is 0.2, a very low debt load. Shifting to the cash flow statement, cash from operations stands at 25.3 billion, reflecting a decrease of 0.1%. Cash from investing activities is minus 3 billion with a minus 80.2% change, while financing activities are at minus 15 billion, showing a minus 150% change over the same period. CapEx has decreased by 3.3%, and free cash flow has decreased by 12.2% to 20.9 billion. Moving forward, let's look at the return metrics to see how the company is utilizing its resources. The return on equity is 6.3%, the return on investment is 9.1%, the return on assets is 3.9%, and the return on invested capital stands at 7.1%. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis by using a discount rate of 9%, a revenue growth rate of 3% for 10 years, and a probability growth rate of 2%. We get a fair value of $207.9. Secondly, using a multiple valuation of 20 times earnings, cash flow, and 25 times free cash flow, we get a fair value of $157.3. And finally, the analyst target price is $124.4. Putting it together, we get an intrinsic value of $163.2. And using a 15% margin of safety, you get an acceptable buy price of $138.7, suggesting that the stock at the current levels is undervalued. To wrap up my analysis, I rate Alibaba as a buy. Now, this is a Chinese stock, and I should mention that although this is a great buy in terms of value, there is also the China aspect to this whole question, to this whole conundrum. This is a buy, of course, but there is also the big a big risk because they're a Chinese company. There is a big risk that their books are not really as clean as American company. Not that American companies are saints or something like that, but Chinese companies have a tendency to cook their books a little. First problem. The second problem, and which is much bigger in my opinion, with Alibaba, is the fact that they are a Chinese stock, and the Chinese stock market is um, not really good. Now, why would the Chinese stock market matter for Alibaba since they're listed on the US stock exchange through an ADR? Well, because most of their operations are in China. Sure, a lot of buyers are from the United States or Europe and so on, because they are basically a platform on which their main business is a platform which suppliers from China sell to diverse companies and people from outside of China, but it's also a big platform inside China. And a lot of their money is stuck in China because there are capital outflow restrictions. So the government can just do what they want. And when their founder, Jack Ma, tried to criticize the government, the Chinese government quickly stopped their IPO, quickly uh, launched an antitrust lawsuit, of course, and won because it's China. And this is a big risk. If the management does something stupid in China, this company could quickly be destroyed by the Chinese government and split into many parts. Of course, China does not really want to do this at the moment because they want to prop up their economy from this deflationary environment that they have over there. So they would probably not do anything like that, a bit too extreme, but still there is a risk with Chinese companies, their book cooking and their government affiliation. Plus, if the United States implements tariffs, then a big client, a big importer of a big trade partner of China will move the trade probably to Mexico or Canada. I'm not sure where the United States will move their trade because Mexico is also going to be tariffed by Trump. But yeah, Alibaba is basically a question of national problems. This is not a problem in terms of value, as I've said repeatedly. This is a clear buy. I mean, it's absurd to say that this is not a buy. This is a buy from every point you can take. Their balance sheet is intact. They're perfectly clean in terms of balance sheet. Balance sheet is actually one of the best ones I've ever seen. They have a good they have good return metrics, not extremely good, but good. They are very undervalued in terms of a DCF, in terms of multiples, intrinsic, in terms of analyst price target. Yeah, if you're willing to take the risk with geopolitical factors that may influence the price, then sure, this is a buy. But if you do not have the risk tolerance for things like that, if you do not like having a company which operates in a country where the government can just do whatever they like, then don't invest. But from a purely value perspective, they are a buy. Now, to wrap up the video, thank you for watching. And if you found this video helpful, please like and subscribe, of course, for more deep value analysis. And also check out my new investing blog featuring in-depth analysis from the link in the description below. See you in the next video. Bye.